shape of the yield curve, credit risks and valuations are the key things to look out for to decide whether sentiment towards banks can improve in 2019. First, the shape of the yield curve. Banks tend to borrow short and lend long, so a steeper curve creates bigger profits for them. But questions as to whether the Fed will keep hiking and still historically low rates in Europe and Japan have flattened the curve in 2018. Will that continue in 2019? Second, credit risks. While loan growth has been a little soft in 2018, there's not been any rise in credit costs for banks. This suggests the economy may be stronger than some fear. If those risks remain low in early 2019, investors may regain faith in the economy and banks also. Third, valuations. Banks always trade at a discount to the rest of the S&P 500. The 25-year average is a 75% discount. They're currently trading, though, at a 60% level compared to the S&P 500 average, yet have made profits every quarter in 2018. If they do the same in 2019, will they enjoy a higher PE rating? Finally, one wild card to keep an eye on, politics. With a Democratic House of Representatives, could executives be dragged to D.C. to face more grillings about possible past behavior? So guys, here's the share price performance as we round out the end of the year. S&P 500 is down 7%, remember. Only JP Morgan comes close to that. It's only down 8.7%. Bank of America down 16%, but the likes of Citi and Goldman Sachs down 30% plus. KBW Banks Index, all in all, down nearly 20%. Highlights why banks really sum up this market right now. Will we see a recession in the next 12 to 18 months? If not, these banks look well priced.
Well, if you mentioned credit concerns, and so far the consumer has proven to be very resilient, but when you take a look at the credit card issuers, they have actually raised reserves for in case consumers start to default. Have we seen that also from the banks?
We've seen it fractionally over the last couple of quarters, Melissa, but nothing major. And this is going to be the key question, I think, going into earnings, which begin in the middle of January with JP Morgan and Wells Fargo. If they report A, decent earnings, but B, loan growth that's at least solid, and credit costs that remain benign, then you'll start to see a continuation of that theme from them, that they think the economy looks fine and maybe people are fretting about it a little bit too much.